Yeah, how you doing, everybody? It's Saturday the 15th of May 2010 and it's just after lunchtime, and I want to talk because somebody else raised it and I was going to do it much later, but I'll do it now. So I've got a couple of bits of information that I needed to be able to do it, but it's quite a complex subject. It's not the simplest thing. It is simple, but to explain it, it's a bit complicated, at least for me anyway. But anyway, I'm going to try and do it. It's about the gold and silver markets and how they're manipulated. Okay, and why they're manipulated, but that's really it's obvious why they're manipulated. But basically, the gold and silver markets are controlled through a thing called the NYMEX, and it's the New York Metal Exchange. Obviously, for obvious reasons, it's based in New York, and it essentially lays down the ground rules for most of the big international markets. Individual countries, like for instance, there's the equivalency of the NYMEX is in London as well, the London Metal Exchange, and they have their own ground rules, but they're basically within the umbrella of what goes on in America, and they generally follow it. If you think about it, because it's by far the biggest market in the world, a colossal market, and what goes on there generally determines the value of what in commodity prices. But we're only going to deal with two metals, and that's gold and silver, and they're traded on a little subsection of the NYMEX called the COMEX, and it deals with four metals. And the reason it deals with them is because they're the most traded in terms of volume and in terms of value on a daily basis. The volumes are colossal. On an average day, there are between 3 and 5 million contracts struck just in New York alone on the COMEX, and the COMEX covers gold, silver, aluminium and copper. Okay, now the way it works is this: you have a group of people, and it's all layers of people. So what you have is you have the man who starts off and he has 10 million to invest, $10 million to invest, and he goes to a brokerage company, and they have within the brokerage house, they would have people who specialise in shares, and they would also have people who specialise in commodities. And one of them reckons, hey, yeah, Joe, that would be a good idea. We're going to take some of your money, and we'll take $1 million of it, and we're going to invest it in commodities. We're going to invest it in either gold or silver. Okay, so you got to think about it this way. So the guy sitting across the table, and he says, yeah, I would like to invest $1 million. That sounds like a good idea. I want to invest $1 million in gold, but I want the gold. Oh, you want the gold? Big problem. Alright. It's not impossible, but it is a problem. So they work out very quickly how much that is in gold, and it's about 60 pounds in gold. That's what it weighs in gold, physically. So it's fit in a suitcase. A couple of gold bars, fire them into a suitcase. It's $1 million. And 60 pounds. So they have to, if he wants it, they actually have to go and get it for him, and I'm sure there'll be a premium on getting that. But if he doesn't want it, it's very, very simple. And what happens then is they ring a guy who's called an actual trader. Okay, and what they do is he's the guy who goes into the pits. Now, the way it's done in NYMEX, and I think within the COMEX market as well, I'm not too sure, but definitely in the NYMEX market, because I've seen it in Chicago, in the mercantile market there, and it's called open cry. And what they have is a huge pit, and they've hundreds, if not thousands, of traders in the pit, and some of them, it's all steps, like a Roman amphitheatre, and they're all trading with one another. Some of them are buying contracts and some of them are selling contracts. Do you understand? And they're all running around with big tags on them, so that when a guy, you can imagine it, I'm selling, I want to buy, let's say, I want to buy the million worth of $1 million worth of gold. So I go into the pit and I start shouting out, I don't know what to be traded, and I don't know what the average size of the contract would be. You couldn't put up $1 million, you'd be swamped. But say it's $50,000, something like that. So a guy would put his hand up and he'd say 50,000, whatever, and you'd say no, I don't want to pay that, and whatever. So what happens is, how these traders make their money is, one is selling, he wants to buy it as cheaply as possible, and the guy who's selling it wants to sell it as expensive as possible. So do you understand? And depending on how well they do, and depending on what the instructions that have been given, they get a little tiny increment of how well they've done. So that's basically all. That's what happens. So trade within a little range on both sides, and they get a little cut. And then of course you have the guys who are the brokers. They never go into the pit. Oh no, the great on Wash goes into the pit and shout. Imagine they actually shout in the pit. Shout out instructions, what they have to sell and what they have to buy. Oh no, brokers don't do that. They have economics degrees. Oh no, my goodness, you can't do that. Might upset my mum, might upset my wife. She saw me doing that. No, they don't do that. They just take a thing called a commission, a nice little commission. And out of $1 million, I'd say if it was $1 million, it would be probably around about 25,000. That'd be their commission. Yeah, just for instructing a guy to buy it. Now, as I say, if it's not physical gold, it can be done instantly, literally instantly. They don't even have to go into the pits to do it. They could do it on a computer screen. But the around between 3 million and 5 million contracts are executed every day on the COMEX market. I'll give you an idea of what goes on. There's a huge market. Alright? And I don't know what the standard size of the contract would be, but I would imagine it's between $20,000 and $50,000. I would imagine it's something like that. It may be more now, I don't know. But 20 years ago it was that sort of money. But give you an idea of what this is a huge market. Now, I always believed, because if you have to imagine, there always has to be a physical amount of gold there, and there always has to be a physical amount of silver, not in the NYMEX market itself, but stored somewhere, so that it's a real thing. So if somebody demands it, they can give it to them. Do you understand? Because the guy might decide, no, I want physical delivery of this gold. Now, the thing happens with silver in a similar way, but if you think about silver, it's a different problem. $1 million worth of silver is a colossal amount of silver, okay? Because it's 50,000 ounces of silver, okay? Give you an idea. So how many is that? 50,000. That's about it's tons. It's a couple of tons of silver. So you know where I'm coming from. So how do you store that? What do you do with that? Where do you have it? Like, you put it in your garage in the house? No. So most of these men are happy enough with a certificate thing that they wave around. Have this certificate, and it tells you JB Yates now owns 2.5 tons of silver, $1 million worth of silver, and it was contracted on this particular day, and it's due for delivery in whenever, a year hence. Okay. And he has that certificate, and he's quite happy, because at any stage what happens is, if the price goes up, say the price increases by 25%, he has the certificate, and he can go back down to the broker and say, I'd like you to sell that. And of course, don't forget, the broker gets his commission first. Number one. Once the deal's done, who's paid first? The broker. Who's paid second? The trader. Who's paid last? The owner. So that's what happens. So what you have is, you have a market, and the market essentially is a derivatives market. Just like that there, you know that? That used to be able to buy, well, that's $1. That used to be able to buy $1 in you've seen all this before, they do it 1,000 times on the internet. This used to be able to buy $1 worth of silver. Alright? When we were on the gold and silver standard, okay? They're no longer, it's not worth anything. And that's what happens in the silver and gold markets. The people don't want the gold or the silver. They don't want the responsibility, because the brokers tell them, oh, you don't want the responsibility of looking after that silver or that gold. Robbers could break into your house and steal it. Okay? No. You just want the certificate. And the vast majority of people are happy enough with the certificate, once you realise what it is. Now, I always believed that they were leveraged to a level of about 10 to 1. And I have to end this now, because I'm going to have to do another rollover to explain what actually they are leveraged to and why it's such a Ponzi scheme. Alright? We'll talk more very, very shortly.